Namaskar. Hello and welcome to PGurus channel. I'm your host 𝙒𝙖𝙩𝙨. This is DGI-378. A look at the markets last week and how they are going to behave in the coming week. You remember that on Wednesday, the Fed upped the interest rates by 75 basis point or 0.75%, and this was followed by the United Kingdom. Essentially, UK and US are in lockstep. We have that information that happened on Wednesday. And then since then, what happened to the markets? Let's hear it all from our co-host and expert, 𝙒𝙗𝙤𝙪𝙤. Sridharji, namaskar and welcome to PGurus channel.
Namaskar. Good morning or good afternoon on this bright Sunday in India, and probably late hours and early hours in New York.
Yes, indeed, sir.
And California.
And in California, it's a late Saturday evening, and I'm going to start by giving you the numbers on the equities, sir. Looks like the markets have gone up based on some good earnings reports. Although I must say, Meta had a terrible quarter. I mean, the stock is down, 43% from the highs, and so is Alphabet, and so is, well, I'll leave it to you, sir. You go ahead.
Well, I think since you come from California, right in the heart of the valley, all the stuff that you talk about has to do with...
The fangs have been defanged, sir.
Okay, you talk about the tech stocks, which is the NASDAQ, but there's other two indexes called the Dow Jones and the S&P, which broadly represents, S&P represents broadly performance across various sectors, a platitude of sectors. First to start with, the markets showed some positive buoyancy, recognizing that the 75 basis points hike has happened. And there was this hint that there's a possibility that rates may taper, and we'll come to that at the later in the program. But there was more, as 𝙒𝙗𝙧𝙤𝙪 rightly pointed out, there were positive earnings. We reported that also on Wednesday. The banking sector performed well, the industrials performed well, the energy sector outperformed well. I think energy sector was up about 28% or so. So on the basis of that, you saw positive moments, not just in the US market, but you also see that feed into the European market, namely the DAX, the 𝙒𝙗𝙧𝙤𝙪, and the CAC, which is the German, the British, as well as the French exchanges. There was also some reasonable moment, though you see the Nikkei, which is primarily the Japanese, driven by a strong appreciating against the dollar, which actually did not help the Japanese companies in terms of the export market. The Shanghai and Hang Seng went up on the basis that all these Wall Street bankers and others attended the meet, that the Hong Kong may be returning back to that market. On the basis of those positive sentiments, you saw the equity numbers kind of go up across the markets. Friday was an unusual day in US. The Dow was up 400 points when the day began, was down 400 points somewhere in the midpoint, or 500 points, and then it went back up. So we almost saw 1,500 points Dow going up. Basically it's just the markets move in what you call in herds or in groups. The markets move hoping that there is some news, positive news, coming next week on November 8th.
Sridharji, couple of questions or couple of observations, sir. Correct me if I'm wrong. One, the market already priced in a 0.75% rate in interest, hike in interest rates, because this has been telegraphed for a long time. If that is the case, then these numbers come as no surprise, isn't it?
No, the number should not be a surprise. They are reflecting the sentiments of the earnings reported, and to the extent what is being reported as an outlook is also factored in. And if one has to look beyond and look at 2023, then you will begin to see some of those numbers as the year begins to peter out. And as you rightly pointed out, the tech sector has taken a hit because the earning forecast for Q4 calendar year or Q3 US financial year doesn't look pretty good. And there's also been a series of layoffs announced right across from Alphabet to Twitter and so on and so forth.
Yes, indeed. And we're going to touch momentarily on that. Maybe is it a good time now to talk about the Twitter shenanigans happening, or shall we talk about it for the next week, sir?
No, we can. If we have time, then we can. Once the markets is finished and the market forecast for the week ahead is finished, then we can possibly
Yeah,
dovetail
let's do
into
that.
that. Yeah.
Let's do that. Viewers, stay tuned. Sridharji has a lot of insights. He was part of some of the investment phases for many of these FANG companies, so he has a fair amount of insight. So stay tuned till the end. Now let's take a look at bond. Can we go back to the previous slide, please? Yeah, one question here I have, sir. Nikkei, is that a shallow stock market or is it a deep stock market? By that, how many stocks are active on a given trading day in Japan?
No, I think the Nikkei is a very deep. It's a very old and very mature index, and there's major companies listed in Nikkei. Automotive companies listed. I don't need to mention the names. Electronic companies listed. Steel manufacturing companies listed. Then you have the retailer listed. So Japanese is a strong export market and a fairly active domestic market. It is not a domestic consumption market. It is very much driven by an export market, very similar to the Korean model, the Korean market, as well as the Taiwanese market. So therefore, it's an export. The earning contraction that one is beginning to see is as the result of the appreciating yen, and as a consequence, both import costs as well as the export revenues, reduction in export revenues driven by two factors. One is the demand contraction that's happening. Not just Japan, everybody else in the world is facing the same epidemic or pandemic, if one has to use the word. And then, of course, the supply chain kind of contraction also hurting them a bit more. And there's also geopolitical uncertainty that is hovering around Japan. Plus, also they have had a long COVID. People remember that Japan is one of the last countries to recover out of the COVID. So all this is feeding into the Nikkei index, but it is a very mature kind of index. In the 80s, late 70s, 80s, up to almost early 90s, it was driven by a kind of a manipulated real estate market that saw Nikkei go up to 24,000 points before the burst came, and it settled down, very similar to the Hong Kong market.
Thank you, sir. And let's go take a look at some bond numbers now. And bonds have also been higher. I mean, the yields have risen, except in Japan. Sridharji, last week, I think the number was 4.128. So there is a slight uptick in the US 10-year bonds.
Yes.
Sometimes, stocks are going up, bonds are also going up. I'm a little confused, sir. I thought they move contrary. One goes up, the other goes down.
I think it is almost like, one line is going much faster than the other line. So therefore, the bond market is about future pricing. The stock market is based on the performance and outlook based on the past quarter and the future earning outlook. So you may see some uptick in some of the markets, in the equity markets, as a result of the earning forecast. Most of the cyclical stocks have taken a hit. So some of the people who are projecting positive earnings on the basis of the rate curve, like financials, demand in the industrials, and then the price increases in the energy sector, is what feeds into the equities market. As far as the bond market is concerned, it is directly feeding into the result of the race. Let me give you some numbers. The 10-year US Treasury, as at December 31st, 2021, was generating a yield of 1.5%. If you recall, in the last quarter, we were saying whether we would go to 2% by end of the year. Now, Today, as we speak, it's at 4%. Okay? The 3 months US Treasury bill at that point of time was 0.94%. This is end of 2021. Today, it is at 4.1%. I don't want to read all the numbers, but I'll give you the high number, which is namely the high yield. The high yield has a spread of 500 basis points. So it's a good time, if you're not into, lock yourself into some bond rates. As at December 31st, 2021, it was 4.7%. Today, it is at 9.4%. So if you're not going to enter the bond market and lock in whichever you feel is comfortable, you're never going to do it. That's my view.
Sir, at that rate, I can see money coming into the United States in billions, sir. This will again put more pressure on some of the developing economies, especially India, the exchange rate.
Now, you just answered what we may be speaking about tomorrow. And shorting the US dollar is what everybody is talking about. And this is these rates, which is why there is a flight to the US dollar. And as a result, because it is generating a better yield, I think one of the good ways to look at it, besides the currency, you kind of take a look at the interest rate band by putting US 10-year, bond 10-year, Japanese yen 10-year, British pound 10-year. You look at the 10-year yields, and then you look at where the US is standing. So there is a large pool of capital moving in, looking for income, right? Especially pension funds and so on. So I think that is the reason why you are seeing demand for the US dollar. As a result, whenever there's a demand, price goes up.
Yes, indeed. And now let's take a look at oil. This too is rising towards the $100 mark. Is it because of the OPEC agreement, or are there more reasons?
Well, I think that there is certainly, first and foremost, there's uncertainty in now, very clearly uncertainty in supply from the Russian side, right? So therefore, there is a supply issue. And there is also one of the reasons why OPEC Plus decided to cut supply was that they wanted this price to go up, because the reason is inflation means they are a very small market. They are reliant on the energy. So therefore, they say, hey, you guys pay more. This is the time. Thus far, you enjoyed the depressed markets, which hurt our economy. Now we are going to squeeze some supply, and then in the process, increase the price. There is a very small report that is coming out of United States. I just need to validate it, that Biden has asked oil companies, especially shale gas companies, to increase the production so more can come in. But I stand to be corrected, and next time we speak, I will confirm this. But if that happens, we may begin to see some price movement going the other way.
Thank you, sir. And let's now move to the next topic, which is commodities. Gold is up again. Again, I'm confused, Sridharji. Gold usually goes up when there is a recession, a fear of a recession, or if the markets have not done well. So the gold going up now is because of fear of recession in Europe, because US doesn't seem to be having that fear.
Well, fear strikes, and it can strike, almost abruptly, as it has happened in many occasions in the past. The gold price, upward momentum in gold prices as a result of two things. One is seasonal demand. I think the second is there is a fear that is being factored in, which is namely that there could be an inevitable recession because the inflation is not coming down, inevitable recession in 2023. So it's time to stock up gold because I cannot afford US dollar. I don't have access to US equity. So therefore, I have access to gold. So the gold demand can happen locally. As a result, the price goes up.
Thank you, sir. Let's go to the next slide here. And we are taking a look at some other commodities also. Many of them have gone up because of supply challenges. We know that Ukraine and Russia struck a deal on the wheat exports and I think some other grain exports, even as they were duking it out on the ground. How is this frenemy situation coming along, sir?
I don't know. I think that it depends. It's like a pendulum. So people are factoring that exports. For example, India is cutting exports. For example, Indonesia and Australia are cutting exports because they fear that they need to stock up for domestic requirements. So the export market from the alternative markets are drying up. Then you have this hiccups in the Ukraine, Russia, Turkey, United Nations, quasi deal in terms of how many ships can pass through Black Sea. Right up until Thursday, Russia was saying, they would not participate. They're reneging the deal because their fear of security and their ships could be attacked. And Crimea has been attacked by British and with British help by the Ukrainians, so they wanted to pull out. But then suddenly their economic numbers are not doing great, and they need. They may also fear that China may not be the only country, or China may not be the buying up all of the oil, so they need to shore up. So they said, okay, they'll come to the party and allow. They also will shore up the shipments, but it takes a little bit of time to get to the cluster in anticipation or for the fear of more reprisals. The wheat, corn, cereals, all these things come from that part of the world. And that is why you are beginning to see right across the spectrum price movements upwards.
And currencies are rising against the dollar. This is unusual again because we've been seeing the other trend, and now we are seeing that the euro, the British pound, and Australian dollar, these are some of the currencies that have gone up. Sridharji, again, these are all things that don't seem to follow a certain pattern that I'm used to. Sir, rid me this doubt, sir. Why is the dollar falling this week?
Well, firstly, Japanese yen will start. We covered this in, there was an intervention, two interventions. So therefore, it went up to 150 to $1. It's now brought back to 146. China is always in to win. And also there's economic questions around China. So therefore, whether it is manipulated number or etc., we don't know. But Chinese renminbi has always been manipulated, so that's on the Asian grind. But then when you look at the what you call as the Western markets, which is the US dollar, which is the euro, the British pound, then the cross rate euro British pound and the AUD, the rates are up because all the countries have also increased their interest rates simultaneously. Euro has increased the rate, GBP has increased the rate. Then you have Australia has also increased the rate. So there has been a rate increase across all these markets. May not be as correlatory as to the US, but nevertheless, the rates have increased. There is a probability of a recession in Europe as much as there's a probability of recession in US. Whereas the Australian market is concerned, they don't believe they will get into a recession. There is a very strong demand for the agro and minerals. Their services within the domestic sector seem to be doing well, coming back out of the COVID. So as a result, you're beginning to see the correlatory effects on the FX market, Sriji.
Next, let's take a look at cryptocurrency, sir. The Bitcoin has again breached the 20,000 barrier and has gone into 21,000. Well, I'm not going to hold my breath. What is the reason for this? Is it just a portfolio allocation, or should we read more into it?
No, I think it's a reallocation that is going on. There is, maybe 7 out of 10 people are skeptics, but there are 3 people out of 10 who are positive. I think this crypto is going to stay. It's an alternative asset. It has not hovered below the levels of 2018, 2019. 2018 was $550 billion market cap. Around 2019, 2020, it went to about $925 billion market cap. It's still hovering around the 1 trillion. It's not 3 trillion, but it's hovering around 1 trillion. Remember, guys, Amazon, Alphabet, all of these, Microsoft, all of these companies were in the 2.5 to now they're all below $2 trillion. So the same gyrations you begin to feel in the crypto market, but crypto is here. It is here to stay as an alternate currency. You will begin to see as we move forward that more Bitcoin-linked gold transactions coming in, which is called as the Bitcoin gold or crypto gold, whichever way you want. So you can have your gold anywhere in the world, and you will be able to use your wallet and convert it into your crypto, do the transaction, so you don't need to be tracked or reporting. And then at the end of the day, when you've shored up enough profits, you can download some into your dollar and go and spend wherever you want to spend. So there is a linkage to the gold coming in that may even trigger more activity in the crypto market.
And now let's take a look at the markets for the next week, and then we'll talk a little bit about what's happening in the tech markets.
Well, I think the market ahead has got three important data points. First and foremost, we are going to get US inflation number. We got the European inflation number. They are high. And no surprise, Europe is probably going to report higher inflation number. Why there's a higher inflation number? We got the pointer last week, I think, as we broke into the Thursday show, if you recall, Thursday, Friday show, I don't remember, that we reported US payrolls very high, 261,000, new jobs came in. So it's a very positive kind of employment numbers, which is not dampening the hopes of the Fed. So we're going to see a higher inflation number reporting coming through, and then more active rate. The second is, which is in my view, the number one headline, November 8th. If both House and Senate shift to Republicans, you're going to see a market surge, because they are going to make sure there is going to be more drilling. There is going to be accommodative rather than this draconian. They're going to look at the supply side, which is what they have been pounding their fists away on the table, that nothing has been done on the supply side. This is a fiscal issue. This is not a monetary issue, and actually the Fed chairman was extensively quizzed as to what you're doing on the fiscal side. He says, no, I'm monetary. Well, your monetary side, how can you go on increasing rates when people don't have enough to eat? So the prices are going up. So I think that will send a very positive moment, and we could finish a very positive year as we close out. And last but not the least is the earnings. Some of the companies like Disney, etc., are going to report earnings. And these three data points will trigger as we move ahead as to where the markets are heading.
Thank you very much, sir. And as a quick wrap up, in terms of how the tech stocks, especially FANG plus T for Twitter, let's take a quick big picture item. Amazon is down. It is in the low 80s or low 90s, high 80s now. And Meta has had a meltdown. That's the only way I can put it. Twitter has had a 50% reduction in workforce. And Netflix hasn't said anything, but we know Netflix numbers aren't doing great for a long time. Apple seems to be okay for now, although I haven't heard any layoffs there too. Sridharji, if the markets are doing so well, why is the tech segment not doing so well?
There are two ways to look at the underlying profits of corporations, G. One is increase revenues, reduce costs, and increase profitability on the same. So many of the S&P 500 companies are cutting costs to increase the profitability. That then cascades into higher dividends, etc., which is why you see the price movements on the stock price. So that's number one. Now, as far as the tech sector is concerned, Apple has done very good performance right across the spectrum. There's some challenges I think they are facing on the supply side of the iPhone 14, but we haven't heard much. But they have generally said they will not give an outlook, but the numbers have been good. So Apple stock relative to all others has performed well. Amazon has got problems with regard to supply chain issues. So there is definitely issues around the retail sales, which they have been flagging. And they have also been talking about some of the labor issues, etc., which they are recalibrating within the market. That's on the Amazon. But I think Amazon will sustain, and once its ad revenue and supply chain issues are rejigged, I think we will begin to see some upward momentum in the Amazon. The two other companies which have got a problem are Alphabet and Twitter. Now, whenever you're going into a recession, what's the thing that will happen? You cut your marketing and advertising spend. So the marketing and advertising spend has a direct correlation. I have said this many times, and I'll continue to say this. Alphabet is a single trick pony driven only by ad revenues. Though they have been trying to say that they are a big, what you call cloud-based player, and they have a cloud architecture and cloud. So they certainly have been competing with the Microsoft, IBM, and Amazon Web Services. The question is this sufficient to offset? No. So I think Alphabet has got headwind, so they're cutting down. Twitter has got a whole swag of issues. And the issues are basically, we are now got a new owner who is going to recalibrate the whole platform. It has suffered significant amount of negative sentiments as it turned woke. And you saw many advertisers initially come, but then pull out. It has been struggling because of its very advocacy-oriented policy, which has directly
85% of its revenues is from advertisements, sir.
Exactly. So it has taken a big hit. So he's already flagged, but Twitter he's already flagged that Elon Musk has flagged. I'm going to see significant revenues. So I have to cut the cost. So he's going to cut the costs. He's paid a high price, so he has to recalibrate the balance sheet in terms of the cost aspect of it. It may take between 6 to 12 months before you see if Mr. Biden's administration doesn't put more inquiries, because he's already flagged more inquiries and more scrutiny and so on, and subject them to the scrutiny. So to me, in that kind of totem pole, Twitter is not something that you would touch. I would stick to, if I was somebody, please take it, this is not a broker-dealer service, and there's a compliance, etc. So we are not giving you any specific advice. But clearly, you can infer from some of our observations, whatever, and use your own judgment. As far as Netflix is concerned, which you touched on, Netflix surprisingly reported more subscriptions and showing signs of a turnaround. And whether it is they have got their audiences right, etc. I have not deep dived into Netflix, but they have shown higher subscription kind of numbers. So, which means that that could be another one which could be on the cusp of a turnaround, and we will know once Disney announces the numbers where they're going. So, to me, Disney and Netflix are in that content entertainment place. So, it will be interesting to see. So, that's my kind of observation, Sriji.
Thank you very much, Sridharji, and we look forward to what plays out in the market this week, and then we'll be back again Monday morning, bright and early, or I should say, no, I take it back. The next one is on Tuesday, right? We are up. We're coming back on
Monday.
Tuesday.
We'll do the with the US dollar.
That's a special segment on the dollar, but global digital daily global insights is back on Tuesday, right? 6 p.m. IST.
Yeah, Tuesdays and Thursdays is the daily global, and then Sundays is the marketplace.
So we're going to get to sleep an extra hour tonight, sir. Yay! As we fall back, and that's going to mean that I'll have to wake up even earlier to make the DGIs. That's okay. I'm used to it. So thank you very much, Sridharji, and we'll be back again Tuesday. But Monday we'll be airing the reason for the mighty dollar, and there are many reasons, and not just one. We've touched upon a few things here. We have given you a teaser. So we'll see you again tomorrow. Namaskar, sir.
Namaskar. Thank you so much. Have a wonderful weekend.